Hello, my name is Dane Williams, and I'm a financial advisor with Howe Financial Services. Obviously, this is a very stressful and uncertain time for everyone. I am very thankful, though, that you've made the time to watch this video. Just know that Howe Financial is here to help you any way we can. On March 27, 2020, in response to the COVID-19 global pandemic, Congress passed the Coronavirus Aid, Relief, and Economic Security Act. It has become more commonly known as the CARES Act. This is historic and sweeping legislation created to help keep workers paid and employed, allow businesses to remain operational, make necessary healthcare system enhancements, and stabilize the economy. The Act contains some provisions designed to provide financial assistance to IRA account holders and retirement plan participants who may be struggling during these tough economic times. I'll walk you through these provisions, and if there are any questions, I will be providing contact information at the end of the presentation for you to contact our office. Okay, let's get started. As I mentioned, the CARES Act contains a few key provisions designed to provide financial assistance to IRA account holders and retirement plan participants if they are negatively impacted in some way by the COVID-19 virus. These include waiver of penalty on early hardship withdrawals, increased loan limits, and waiver of RMDs. Let's take a closer look at each of these. The CARES Act waives the additional 10% penalty tax you would normally pay on early, that is pre-age 59 and a half, withdrawals up to $100,000 from an employer retirement plan or IRA. Okay, so who qualifies? An individual qualifies for the exemption in the following circumstances. If they're diagnosed with COVID-19, if their spouse or dependent is diagnosed with COVID-19, if they're experiencing adverse financial consequences as a result of being quarantined, furloughed, laid off, having work hours reduced, or being unable to work due to lack of childcare, all due to COVID-19. Closing or reducing hours of a business owned or operated by the individual due to COVID-19, or thirdly, other factors as determined by the Treasury Secretary. Individuals may self-certify that they qualify. So while there are no specific details in the CARES Act, several industry sources have said that given the extensive list of potential individuals who may qualify for relief under the Act, it seems that the congressional intent was to make relief available as broadly as possible. The IRS will likely operate in kind and take a liberal view of who has been impacted by the coronavirus enough to qualify for a coronavirus-related distribution request. Plan and account administrators can rely on an individual's self-certification that they meet the requirements of a coronavirus-related hardship distribution at the time they make the request. Hardship withdrawals are still subject to income tax. However, a coronavirus-related distribution under the Act can be included proportionally in the qualified individual's taxable income over a 3-year period, unless the individual elects to have it taxed in the year of distribution. In addition, the distribution will not be treated as an eligible rollover distribution, so the mandatory 20% withholding does not apply. The Act also allows a qualified individual who takes a coronavirus-related distribution to repay that amount tax-free back into the plan within 3 years of taking the distribution. Such repayment will be treated as a rollover contribution and not be subject to annual maximum contribution limits typically imposed on IRAs and workplace retirement plans. The CARES Act doubles the current retirement plan loan limits to the lesser of $100,000 or 100% of a qualified individual's vested account balance in the plan. This increased loan amount is available for loans made during the 180-day period beginning on the date of enactment. In addition, the Act extends the due date of any qualified individual's loan repayment that would otherwise be due during 2020, but on or after the date of enactment, to 1 year after the otherwise applicable due date. The qualifications for a corona-related loan distribution are the same as with hardship withdrawals. Retirement plans may choose, but are not required, to adopt these rules immediately, even if the plan does not currently allow for hardship distributions or loans. The plan amendment deadline for adopting these new rules would be no earlier than the last day of the first plan year beginning on or after January 1st, 2022, or later as prescribed by the Treasury Secretary. If the plan does not expressly provide for loans or distributions, the employer can generally amend the plan at any time to permit them. Employers may also be able to expand the availability of distributions or loans already available under their plans, but should seek legal counsel to ensure any expansion would be permitted under the law. For example, for furloughs, applicable tax laws permit suspension of planned loan repayment for up to 1 year, and the loan can be re-amortized over the original term once the employee returns to work. All right, so let's talk a little bit about required minimum distributions, or RMDs as they're commonly known. The CARES Act suspends RMDs during 2020. The relief applies to both retirement account owners and beneficiaries taking stretch distributions. The CARES Act not only eliminates RMDs for 2020, but any RMDs that otherwise needed to be taken in 2020. More specifically, individuals who turned 70 and a half in 2019 that did not take their first RMD in 2019 and thus would have normally been required to take such a distribution by April 1st, 2020, as well as a second RMD for 2020 by the end of the year, do not have to take either their 2019 RMD or their 2020 RMD. There is some relief available for individuals who already took their RMD in 2020. In April, the IRS extended a number of deadlines for certain actions that are otherwise due to be performed on or after April 1st, 2020, and before July 15th, 2020 to July 15th, 2020. This extension indirectly provides a way for individuals who already took an RMD to put it back into their IRA or plan and eliminate the tax bill. Here's how it works. Normally, anyone who takes a distribution from their IRA or plan can roll those funds over within 60 days. The IRS extension to July 15, 2020 means that anyone who took an RMD between February 1st, 2020 and May 15th, 2020 can still put the money back into their IRA or plan. Unfortunately, if an individual took an RMD in January, they do not appear to qualify for any relief, based on what is known as of late April 2020. Please note that this relief does not include relief from the once per year IRA rollover rule. Only one IRA to IRA or Roth IRA to Roth IRA rollover per 365 days, not a calendar year, is permitted. If anyone has done one of these rollovers within the 365 days preceding the date they received their RMD, then they are disqualified from taking advantage of this 60-day extension. This rule only applies to IRA rollovers and not to company plan retirement plans. For example, rollovers from company plans to IRAs or vice versa are not subject to the once per year rule. Neither are Roth conversions. One final thing to note, under the CARES Act, 2020 RMDs were also waived for beneficiaries. However, non-spouse beneficiaries don't qualify for the 60-day extension because, under the law, a non-spouse beneficiary cannot do a 60-day rollover. There is always a chance that the IRS may address providing additional relief on all of these RMD issues and rules at a later date. The Act provides single employer defined benefit plan funding relief by giving companies more time to meet their funding obligations by delaying the due date for any contribution otherwise due during 2020 until January 1st, 2021. At that time, contributions due earlier would be due with interest. The provision also provides that a plan's status for benefit restrictions as of December 31st, 2019 will apply throughout 2020, such that a plan sponsor may elect to treat the plan's adjusted funding target attainment percentage for the last plan year ending before January 1st, 2020 as the adjusted funding target attainment percentage for plan years which include calendar year 2020. The CARES Act expands the Department of Labor's authority to postpone certain deadlines under ERISA. In general, the legislation expands the circumstances to go beyond a terroristic or military action to also include a public health emergency declared by the Secretary of Health and Human Services under the Public Health Service Act. The DOL, Department of Labor, and Treasury Department may choose to provide relief from various filing requirements, such as an automatic extension of the Form 5500 series for retirement plans, an extension to the deadline for correcting a failed ADP or ACP test, and an extension of the period for distributing excess contributions and excess aggregate contributions under a plan, among others. However, as of March 31st, 2020, the agencies have not yet granted specific extensions to any plan filing requirements. We will communicate any extensions that may be granted in the near future. This presentation was prepared by LPL Financial, and it was created for educational and informational purposes only and is not intended as ERISA tax, legal, or investment advice. If you are seeking investment advice specific to your needs, such advice services must be obtained on your own separate from this educational presentation. As promised, here's my contact information. The phone number is to our main office in Sparta, and my email address if you'd like to send me an email, if you have any questions related to the CARES Act, or if there's anything else that we can do for you, just know How Financial is here and ready to take your call and hopefully answer any questions that you have related to your financial situation. Thank you again for listening and hope you have a great day. Take care.